My name is Jane Horonsky and I'm a lecturer in Auditing and Assurance Services. I will be guiding you through 3 video modules on audit reporting. In Part 1, we covered the standard or unmodified audit report and the new requirement for the audit report to include what are known as key audit matters. In this video, Part 2, we will cover potential modifications to the audit report. Auditors take all reasonable steps to be in a position to be able to express an unmodified opinion. However, there may be circumstances or conditions where it is not possible to conclude that the financial report as a whole is free of material misstatement, and therefore there has to be a departure from an unmodified opinion. A modified report is necessary. ASA 705 is the standard covering modifications to the auditor's report. Under this standard, there are only 2 conditions requiring a departure from an unmodified opinion. First, on the basis of audit evidence, the report as a whole is not free of material misstatement. Or second, the auditor is unable to obtain sufficient appropriate evidence on which to base a conclusion that the report as a whole is free of material misstatement. Note that both conditions are expressed in terms of audit evidence as the critical condition. There's either positive evidence of the existence of a material misstatement, or there is the absence of evidence on which to base a conclusion. Whenever any of the 2 conditions requiring a departure from an unmodified opinion exists, a report other than an unmodified report must be issued. 3 types of audit reports are possible. The first is a qualified audit opinion. The auditor cannot say without qualification that the whole report is true and fair. It is true and fair except for whatever the subject matter of the qualification is. The second type of modification is an adverse opinion. This is where the auditor is communicating that the report as a whole is not true and fair. The third type of modification is a disclaimer of opinion. This is not an opinion. Rather, the auditor is saying, I don't have enough evidence on which to base an opinion about the whole report. The difference between an adverse opinion and a disclaimer is as follows. The disclaimer is not an opinion. There is no evidence, so 0 assurance is provided. The adverse opinion is based on evidence. It is giving positive assurance that the whole report is a load of rubbish and cannot be relied on. This slide summarises the relationship between the problem condition and the appropriate audit report or opinion to give. The key determining factor is the level of materiality of the issue. That is, how severe is the problem. Evidence of a material misstatement will result in a qualified audit opinion. The problem is confined to one area of the financial report. The report as a whole is true and fair except for that area. However, if the material misstatement is pervasive, that is, it pervades or affects the whole report, then an adverse opinion should be given. When there is a lack of sufficient appropriate audit evidence, which is material but is only about one area of the report, then the audit opinion will be qualified. If the lack of evidence is pervasive, that is, there is a lack of evidence about the whole report, then the auditor must disclaim an opinion. Finally, we will discuss how a material uncertainty about going concern will affect the audit report. As you already know, as part of the audit completion procedures, the auditor must reassess the validity of the going concern assumption underlying the valuation of assets and liabilities. The auditor must be aware of going concern problem indicators, such as those shown on this slide and further detailed in ASA 570 on going concern. Directors of a company are required by the Corporations Act to disclose any going concern problems. If they do so, the auditors will give an unmodified opinion. This is because it is true and fair that there are going concern problems. However, the audit report must now also include a separate paragraph entitled Material Uncertainty Relating to Going Concern, which describes the problem and directs the reader to the director's disclosure about the matter. The going concern problem must also be included as a key audit matter. However, what happens if appropriate disclosures about going concern problems have not been made? In these circumstances, an unmodified audit opinion is no longer appropriate. The auditor must choose between a qualified or an adverse opinion, depending on the materiality of the problem. If the auditor is certain that going concern is not a valid basis, and assets and liabilities should actually be recorded at liquidation values, then an adverse opinion becomes appropriate. This concludes the second of our videos of audit reporting, where we have covered modifications to the audit report, that is, the departures from a standard unmodified audit report.